Howdy, Jacob here. Today we're looking at Bath and Body Works. In the specialty retail industry, if you've ever gone to a mall and walked past it, you definitely know you're walking past it because you get all the whiffs of all their fragrances and everything. But if we look at the numbers here, 10 billion market cap on 13.6 billion enterprise value. Founded in 1963, they sell beauty products, home fragrance, body care, soaps, etc. They did get hit pretty hard from COVID. Let's see, 2019, 2020 dropped over 50%, and they have been going up a little bit since then, but definitely not even close to where they were pre-COVID. Let's see if there was any sell-offs or anything. So 2019, 2020, we do see capital expenditures drop a bit. So they spent less on increasing stores, I'm assuming. And cash flow operations is actually down a bit. So that's not a super positive sign. They also cut their dividend though in half and is still nowhere near where it was over here, which I'm comfortable with. If you pay a dividend, it's tough because when times are tough, it's one of the first things to go, but it's one of the first things that the investors don't want it to go. So majority of the cash, share purchases, paying a dividend, but it doesn't look like there were any sell-offs here. So it looks like COVID just had a huge dent on all of their income. It looks like people didn't want to go to the mall to get everything they sell, home fragrances, body care, soap, and rather buy it online or, I guess, cheaper just from any old retail store. So it still looks like they're making a lot of money, so you can't deny that. You can say it's a dying business, but a dying business doesn't create $700 million a year in free cash flow. You just couldn't convince me of that. But I mean, it could be on the decline, absolutely. But to say dying, I think we need to dig more into what the definition of dying is. But anyways, I do think that growth isn't going to be very substantial, if much at all, really. But again, we are seeing over 40% gross margin, almost 20% on operating margin, and good return on money reinvested back in the business. But like we've already looked at, they haven't been reinvesting too much, really just dividend and share repurchases in their form of free cash flow payment. $1 billion cash on hand with $4 billion in long-term debt. So they went into debt a little bit from COVID as well, but they really aren't in a lot more debt than they've been in the past. But it's still a good amount for me. So $4 billion in relation to, I mean, they do have over $1 billion in their 5-year average free cash flow, so it is just about 4 years. There's not really like a dead figure for that. Under 5 years, feel fine. I mean, you can prefer under 2 or 3 though. I definitely prefer less debt over more debt. You don't want the company over leveraged, especially when it is very leveraged. You definitely got to pay more attention of when it's due and what their leverage ratios can be and everything. But for me right now, I don't think that it's a terrible concern on their balance sheet. Their use of payment, they do have about $500 million the last 2 years going towards debt reduction, which is about half of their free cash flow. And then you're seeing maybe a third in share purchases, maybe a fourth in share purchases, and then a fourth in dividend payout. So not a whole lot of reinvestment. We do see that high return on invested capital, but they're not reinvesting it back with themselves, which to me does not make me put in a lot of premium on their terminal PE and price free cash flow. But let's remain our assumptions here. On the on the revenue growth side, I think I would feel comfortable with 3%. And then I do think that it's a well-established company. I don't think there's a whole lot of growth out of them, but I don't know if I feel too comfortable being much below 13, which is still below the market average historically, and then I wouldn't want it much higher. So I think I am still comfortable with that PE right there. And then for margins, maybe we'll do 12 and let's do 11 and 12 because they have been somewhat consistent. And then for share repurchases, 1% would be about $100 million. $248 million is about a quarter of their free cash flow, which is what they've done historically. I feel pretty good about that. Their dividend, as they have increased that recently. Let's see. Okay, well, it got cut from COVID. They can still afford it. Maybe I'll increase that with their revenue growth. So that's still assuming that about 50% goes towards, let's say 25 share repurchases, 25 dividend, 50% to debt reduction, acquisitions that make sense, and then reinvestment opportunities. So I'm feeling pretty good about that. We're saying the company's price needs to fall 34% before you get to the return we're looking for here, which honestly isn't terribly far off. So it is retail. I think there are a lot more opportunities. I don't think they got a moat in this retail section. I know that some people still really enjoy going to the malls. I do see it's kind of iffy where I live, whether some of the malls I'm at are very heavy populated with individuals or, not so much. I do see empty ones, and then the one right by my house is dead empty, but the one a couple miles up the road, I guess it's more touristy, is definitely busy all the time. So it really just depends where you are. But they're pretty staple-esque for malls. Not, I don't know as much as like Auntie Annie's or whatever, but they're a pretty big staple there. But hopefully you enjoy the video and do have a great rest of your day. Thank you so much.